Hello and happy Monday. I'm Noel Lim for ASEAN Speaks, Maybank Investment Banking Group. Can we expect back-to-back interest rate hikes by the Fed this year to play catch-up with inflation? How will this affect the timing of rate hikes in Indonesia, Thailand and Malaysia? Then casting our eyes on crude palm oil prices, for how long can they continue to defy gravity? And where can we find love in Malaysia aviation and in the Philippines e-commerce and property segments? Chua Hak, our regional co-head of macro research, checks in with the research teams in today's Monday briefing.
Hey, hi, morning. It's 14 Feb. Happy Valentine's Day. Just a quick recap of last week. Markets continue to be volatile with Ukraine and US Fed at center stage. President Biden warned that a Russian invasion could come anytime. Russia called such allegations as provocative speculation. Gold prices rose to a 3-month high on safe haven demand, while Brent oil prices crossed $94 per barrel, the 8th-weekly gain to the highest since August 2014. Main highlight last week was the US inflation print on Thursday, when inflation hit 7.5% in Jan. That's the highest in 40 years, and again confounded like forecast that price pressures would be easing off. Core CPI, that's excluding food and energy, rose 6%. Markets are now pricing in 6 or 7 rate hikes this year and 50 basis point rate rise in March. The 2-year US government bond yield suffered its biggest one-day sell-off since 2009, trading now at 1.63%. We will have Winson on the call to talk about the sell-off in the US bond market. James Bullard, one of the Fed's most hawkish voting member, fueled the sell-off by saying that he backed a 50 basis point rate hike in March and that the Fed should be open to the idea of responding sooner and hiking in an inter-meeting move before the March meeting. S&P fell 1.8% last week. Tech-heavy Nasdaq fell 2.2%. MSCI Asia Pacific was more resilient, gained 1.4% for the week, but this may have not fully reflected the sharp sell-off in the US markets on Friday night. The US dollar DXY gained 0.6% last week, while the euro fell by 0.9%. Malaysian markets, which have been a laggard, rallied actually last week and outperformed in Asia and ASEAN, with the KLCI rising 3.7%. Singapore, Thailand, Indonesia markets also ended higher for the week. On COVID and Omicron, more countries, UK, Denmark, US, are all planning to relax social and travel restrictions, even Malaysia and Vietnam, on hopes that the Omicron has passed its peak. The clear exception is China and Hong Kong, with Hong Kong actually last week imposing stricter measures, given their zero COVID strategy. This week, look out for key US macro releases. That includes January producer prices, US retail sales, industrial production, and housing data. The Fed will also be releasing the minutes of last month's monetary policy decision, and I think markets will be looking out for clues on the Fed's next move. In Europe, the EU will be releasing the 4Q GDP growth. Here in Asia, the finance ministers and central bankers from the G20 are set to meet for the first time this year in Jakarta. China will be releasing January CPI and PPI, and the PBOC meeting and decision on the medium-term lending facility rates will also be a focus following last month's reduction. Looking at consensus, it doesn't seem that markets are expecting another rate cut from the PBOC this week. The Philippine Central Bank will be holding its meeting on Thursday and will likely keep its benchmark rate steady. On Friday this week, Singapore will be unveiling Budget 2022, where the focus will be on the timing of the GST hike, possible wealth taxes, and higher carbon taxes. Earnings out this week include Walmart, Airbnb, Airbus, AIG, Applied Materials, BHP, Glencore, Heineken, NatWest Group, Shopify, and some of the Singapore banks. Today, we have Chua on the central bank policy decisions in Indonesia and Thailand last week, Suhaimi on Malaysia's 4Q GDP and the growth outlook, Winson on the US bond market sell-off in reaction to the US inflation shock, Chee Ting on palm oil prices and Indonesia's new export policy, Shao on rising air cargo rates and potential beneficiaries, Daphne on the Philippines e-commerce boom, and Miguel on the Philippine property stocks. So let's kick off first with Chua. So Chua, both central banks in Indonesia and Thailand left their policy rates unchanged last week. Any key takeaways from the Bank Indonesia meeting? Are they worried about inflation, and when are we expecting BI to hike?
Good morning, everyone. While holding its policy rate, BI did reaffirm the increase in the reserve requirement ratio for banks. Starting 1st of March, from 3.5 to 5% before being raised to 6% in June and 6.5% from September. I think the key highlights from this meeting was also the comments on inflation. BI still stayed quite sanguine about inflation. The governor commented that the recent uptick at 2.2% in January for headline CPI was partly driven by improving domestic demand. He reiterated that the policy rate will be kept low until there are clear signs of a pickup in inflation. BI expects inflationary pressures to start building only in 2023 and will assess price pressures more closely from the third quarter onwards. GDP growth forecast was maintained at 4.7 to 5.5% by BI, although the Omicron variant does present some downside risks for the first quarter. We maintain our call for BI to deliver 3 25 bips rate hikes this year to bring its policy rate to 4.25% by end of the year. We expect the first rate hike in the second quarter as the Fed kickstarts its tightening cycle. The current account deficit is expected to widen to around 2% of GDP this year, weakening the support for the rupiah.
So Jay, what about the Bank of Thailand meeting last week? Any key takeaways?
Yeah, the highlight of BOT's meeting was really on rising inflationary risks on the back of energy and raw food prices. In January, headline inflation jumped to 3.2%, above BOT's target range of 1 to 3. There was not much indication of broad-based increases in prices of goods and services so far, according to BOT, as the share of domestic goods and services for which price increase above average was less than 10%, compared to around 35% in the US. BOT did caution that the cost pass-through from producers to consumer prices could increase if energy and raw food prices stay elevated for longer than expected, or if the supply constraint problems broaden to other goods. We are looking at inflation to peak in the first quarter at around 3.7% due to last year's low base effects, before easing back to BOT's target range by the second half of the year. We are looking at BOT to raise its policy rate by 25 bips to 0.75% as early as the third quarter, in line with the monetary policy normalization by most global central banks.
So Jay, you wrote a thematic report on how Thailand will plug their wide fiscal deficit gap. So what tax measures might be on the table?
So the government has proposed measures to raise revenue. Some of the measures that were announced include a 0.1% stock transaction tax for investors with a total monthly turnover of $30,000. That's expected to generate an additional 15 to 20 billion baht of revenue per year. The land and buildings tax, which enjoyed a 90% tax cut from June 2020 until last year, will also be restored this year. And there are also plans to impose a 300 baht fee on foreign tourists starting April. Combined, these measures will generate additional revenue of around 0.5% of GDP a year. But we think that there are other ways to raise revenue that can be considered by the government. The major one would be a VAT rate hike. The VAT in Thailand has been maintained at 7% from the original 10% since 1999. And a 3 percentage point hike will be able to raise additional revenue of around 300 billion baht or 1.7% of GDP by our estimates. There's also room to improve personal income tax collection with the number of registered personal income tax payers at just 30% of total employment. Thailand can also consider a carbon tax. It could start as low as $3 per ton, as adopted by neighboring Singapore, which is at $3.7, and Indonesia at $2.1. Improving tax collection on imported low-value goods or cross-border e-commerce will also help to expand Thailand's revenue base, as online sales have more than tripled in volume in 2021 compared to 2019.
Thanks, Jay. Let's bring in Suhaimi. Suhaimi, I think Malaysia reported 4Q GDP last week, 3.6%. So is this within your expectations, and what's your growth outlook for this year?
Thanks, Harbin. The Malaysian economy rebounded by 3.6% year-on-year last quarter against the contraction of 4.5% in third quarter of 2021. So this sits between our estimate of 3.8% and consensus 3.3% growth. For the whole of 2021, economy rebounded 3.1%, compared with the decline of 5.6% in 2020. But last year's real GDP was still about 2.7% below 2019 levels. And I mean, this basically underscore the uneven and what you call underwhelming recovery last year, because we still have sectors like services, mining, agriculture, construction, as well as demand aggregates like consumer spending and investment that remain below 2019 levels as of last year. The exception was manufacturing and external trade, thanks to the global economic rebound, as well as government spending, obviously due to the fiscal stimulus measures over the past 2 years.
So, I mean, is Bank Negara too sanguine on inflation? Your forecast looks extremely low. And when do you think Bank Negara will actually hike policy rates?
Certainly, at this point, Bank Negara is keeping or sticking to its view that inflation will actually moderate this year to 2.1% from the average of 2.5% last year. We are looking at, I guess, more persistence in inflation, with inflation to remain at 2.5%, the same as last year. There's always upside risk to that number. But because of Bank Negara's view on inflation, we sense, and based on a recent media interview by Bank Negara Governor, the central bank said that it is not ready to withdraw its policy support, despite economic recovery that is expected to gain traction and gather momentum this year. Because on balance, from Bank Negara perspective, the risk remain tilted to the downside. And she made it clear that Bank Negara will not move in lockstep with US Fed. In a way, this is kind of consistent with our view on OPR, which going to stay at this record low 1.75% for much of this year before our expectation of a single 25 basis point hike in fourth quarter of this year.
So just one last question. I was wondering, in a historical context, has there been many episodes in the past where Bank Negara tightens so much far less than the Fed, since markets are now pricing in 6 or 7 Fed rate hikes this year?
I think if you look at the history of OPR, which came into existence in 2004, I think generally and consistently, the quantum of changes in Bank Negara's OPR is always less than Fed fund rate. So, for example, during GFC, OPR was cut 150 basis point. Fed fund rate was lowered by, I think, 500 basis point. And under COVID, again, we saw the same thing. OPR was cut by 125 bips. Fed fund rate was lowered by 225 bips. But I think what is more interesting actually is on the timing of changes, particularly in the rate hike cycle between the two central banks. Certainly, historically, there is no situation where Bank Negara moved in tandem with Fed. In fact, when you look at the last round of interest rate hike cycle, that is right after the global financial crisis, Bank Negara moved well ahead of Fed fund rate by as much as almost 6 years ahead. So I think this time around, I still believe that we should similarly see the same thing, in the sense that the timing of rate hike would be such that Fed would go first, followed later by Bank Negara. And I think the quantum, at least for this year, would definitely be much lesser in the case of Bank Negara than Fed. But we do expect the momentum of rate hike cycle to increase next year onwards.
So, Winson, the US bond market sold off last week, with the 10-year breaking the 2% after inflation climbed to 7.5%. And I think the 2-year bond yield jumped by even more. So what's your take now on where bond yields might go as markets are starting to price in 6 or 7 Fed rate hikes this year?
Hi, morning, Habib. Yeah, it was another very volatile week, taking the year-to-date increase for the 10-year in total about 40 bips, and the 2-year even more, about 80 bips. There has been a lot of hawkish repricing in the US rates over the past few months. For example, In September last year, the market was not even pricing in one hike in 2022, but that has changed by December to 3 hikes. January, 5 hikes, and currently we are talking about 6 to 7 hikes alone in 2022. I think it has become quite clear by now that the Fed is behind the curve on rate normalization. So not only they need to hike rate, and they need to hike it faster than what they wanted initially. But I would say at the current pricing of about 6 to 7 rate hikes, I think it does seem to be quite full in the price. With only 7 FOMC meetings left for the year, that literally means a back-to-back rate increase in every single meeting, or perhaps 50 pip increase instead of the typical 25 in some of those meetings, something we haven't seen for a long time, by about 15 to 20 years. I still think the rate hike cycle for the Fed this time is going to be in a compressed window where they need to hike rate aggressively, but it may not last for very long. So can you go higher from here? Actually, the current levels for the 2-year and 10-year, they are very close to our forecast for 2022, 150 for the 2-year and 190 for the 10-year. We have actually raised our outlook on the Treasury to neutral from bearish for quite a long time. So maybe 2-year yield can still go slightly higher, moderately higher. But for the long end, again, I think we just need to repeat the point. It's not really or solely a reflection of rate expectation in the next 1 to 2 years. There is a cyclical element to where the long end yield is. If the Fed tightens too fast, it could actually raise the question on the longevity of the economic cycle.
Winson, on that, I guess what's the likelihood that the yield curve will invert by the end of the year if the Fed does hike 7 times? Any lessons from history? Because an inverted yield curve typically signals a recession.
Yeah, that's right. An inverted yield curve is probably the best leading indicator for recession. I think the Fed should be concerned about it. When the 10-year yield crossed 2% last week, I think it did grab a lot of headline attention, but I think investors should also focus on the shape of the yield curve. If you look at it in the past, probably we don't have to go to that many, but just the recent one or two, let's say in 1999 to 2000, the Fed actually hike rate quite aggressively, I would say, in about 1.75% in a year. And the curve actually inverted and the recession followed in 2001. So pre-GFC, the Fed hike rate also quite aggressively. Between 2004 and 2006, they hiked from 1% to more than 5% in about 2 years, a back-to-back increase. And the yield curve also started to invert even before the Fed finished hiking rate, and a recession followed by the end of 2007. So if they do hike rate 7 times this year, I think the chances for an inverted yield curve will certainly be a lot higher over the next 12 months. Being late in the game on policy normalization in this cycle, I think the Fed has unfortunately put themselves in a very difficult positions. This is actually the biggest concern we have when we were writing the 2022 fixed income outlook. It's actually our wildcard. We think there is a non-negligible possibility that we might see late cycle pricing on the Treasury curve in 2022. It doesn't seem to be very far-fetched scenario. So what the Fed can do, I think they need to be very careful about the pace of rate hike, and ideally go in tandem with the balance sheet reduction, because it is actually a way to keep the curve steep.
Thanks, Winson. Let's bring in Chee Ting. So Chee Ting, palm oil prices, as you wrote in your report, are off to a good start, continues to defy gravity, has kept on rising this year. Some of the Malaysian palm oil stocks have actually started moving last week. So what's driving palm oil prices, and what's the outlook for the rest of the year?
Morning, Habib. Palm oil prices have gained immensely from the price strength of competing oils, namely soybean oil so far this year. The drought experience in the southern part of Brazil and Argentina, the world number 1 and number 3 soybean producing countries, lifted overall price sentiment. Late last year, the world was looking forward to a record South American harvest, but that prospect faded the past 2 months. Now the market is anticipating this season's crop to be below that of last year. As for palm oil itself, the Malaysia's MPOB January stockpile has remained high as the industry entered into seasonally low production cycle. Over in Indonesia, the world's largest producer and exporter of palm oil, the government's recent export ruling requiring exporters to set aside 20% of the industry's export volume for domestic market obligation raised some concern over the availability of palm oil in the global market, at least in the short term. At the same time, the Indonesian government has also capped the prices of local CPO at 9,300 rupiah per kg and for Olein at 10,300 rupiah per kg for the domestic cooking oil market, way below Indonesia's domestic CPO price of around 15,000 rupiah per kg. Now, this ruling came at a time when palm oil is tight in supply, and this has helped push CPO price to new highs in the past 2 weeks. In terms of CPO price outlook, we maintain our view of a possible two halves in 2022, as current CPO prices are not sustainable, at least not into second half. As and when supply normalizes, prices will correct, which is likely to be in second half, which is seasonal in nature. However, there is still much uncertainty on the global supply outlook in the second half, given the weather risk, high fertilizer prices, disrupted fertilizer supplies, and labor shortage in Malaysia. These continue to pose challenges on our anticipated supply recovery in second half of this year. Having said that, we believe CPO price will remain lofty in the immediate 2 to 3 months.
So Chee Ting, can you remind us what are your top buys right now?
Your top buys in the region remains with KL Kepong, Sarau Oil Palms, and Ulster Plantations.
Thank you. Let's move on to Shao. Shao, air cargo rates are climbing to record highs, providing some relief for the aviation sector. What's driving this surge in air cargo rates, and will this continue for the rest of the year?
Hi, Hak-bin. Good morning. Surprising thing is that this rally in the air cargo rates is actually being caused by COVID-19. COVID-19 has caused less belly cargo capacity, supply chain disruptions, and a high demand for e-commerce and PPE. In fact, the curious thing is that air cargo rates appear to be tracking the number of new COVID-19 cases worldwide. The length of this rally will depend on how long this pandemic goes on, but judging from the rate that the Omicron variant is spreading, my feeling is that it will probably last for the most of this year.
So does air cargo contribute a large proportion of businesses for airlines? And which companies are you recommending to play the air cargo boom?
Right. According to IATA, pre-COVID, cargo used to account for only about 10 to 15% of airlines revenue. That jumped a bit to 36% in 2020. My suspicion is that it probably rose to 40% and above in 2021. So it's increasingly a more important segment of the business for the aviation sector. I mean, you will see that in some news reports that the cargo business is actually keeping some airlines afloat. I think recently there was a news that Korean Airlines actually generated a profit due to the cargo business. So that's a good sign. In Malaysia, there are not many listed air cargo plays. The two big air cargo plays in Malaysia are actually private companies, but we are getting more interested in AirAsia X. They had been struggling for many years as a low-cost, long-haul airline. But the sweet thing about them is that they are operating A330s, Airbus 330s, and there is a structural shift in the air cargo business from Boeing 767s to Airbus 330s. So it just so happens that they are operating the same planes that is now the favorite aircraft being used to transport cargo around the world right now. So they've just come out of the debt restructuring. So hopefully they will get to capitalize on these air cargo rates going forward.
Okay, thanks, Shao Yang. Daphne, on your thematic report on the Philippine e-commerce boom, so how are the Philippine companies adapting to and taking advantage of this boom, and what are the impediments in terms of logistics?
Hi, good morning. So for Philippine companies, particularly consumer manufacturers and retailers, they have started to explore their own online platform, although penetration remains to be at a low single digit at the moment. So for retailers, they have started to implement a multi-channel strategy, allowing shoppers to shop in-store, do pickups, or order online and have them delivered to their homes. In terms of logistics, Philippines lagged against its ASEAN peers. and is the worst performer in all logistics-related infrastructure categories. This is underpinned by the inadequacy of infrastructure, particularly in transport, telecommunication, health, and water supply, which are what the Philippine Development Plan of 2017 to 2022 intends to address. So key performance issues faced by Philippine logistics industry are: one, reliability in terms of on-time delivery, damage rate, and ratio of returns; two, delays in cargo and customs; and lastly, congestion and weather-related issues.
So Daphne, which companies could emerge as the big winners in this e-commerce boom?
Okay, so among our coverage, RHI presents the biggest measurable e-commerce exposure with 3.5% e-commerce sales contribution as a percentage of total sales in the 9 months, ahead of its own 2021 target of 2 to 3%. And as of the 9 months, RHI's e-commerce value growth is already 3.5 times of its prior year's performance. On top of this, RHI has also invested in Grocery, which is a platform-based startup launched in 2016 that offers B2B solutions to sari-sari store owners, inventory procurement, and value-added services.
Okay, thanks, Daphne. Miguel, I think the foreign ownership of Philippine property stocks has fallen to their lowest level in 6 years. So why is the sector so unloved, and how low can it go?
Good morning, everyone. Yes, correct. Foreign ownership levels for Philippine property stocks are at their lowest in 6 years. They declined by 6 to 8% from 2015. And this is consistent with persistent net foreign outflow seen in the Philippine market, which is more apparent for cyclical sectors like property. I think the being unloved by the market is a function of many things. On one hand, there's been broad weakness in the Philippine market, and by extension, broad weakness in emerging markets, and cyclicals tend to take the brunt of that, such as property. The other is that specific to the property sector, there were overhangs relating to the Philippine offshore gaming operators, especially with uncertainty surrounding their operations and their tax regime. And this, I think, manifested clearly in 2019 when certain operators were forced were displaced or forced to close operations. And I think that's led to concerns on the sector.
So Miguel, what are your top picks in this Philippine property sector, and do you see any near-term catalysts?
So our overall theme for 2022, our investment thesis, is go for the developers over the landlords, or development-heavy names over leasing-heavy names. And our top pick is Ayala Land. The reason why we prefer developers such as Ayala Land is because they're less sensitive to changes in mobility restrictions and potential second waves or new strains. In terms of our quarantine system here in the Philippines, developers tend to have continuous operations regardless of how stringent the quarantine measures are. And we do expect Ayala Land to deliver sector-leading earnings growth at 32% this 2022. Catalysts in our view. So first is progressive reopening of the economy, which benefits as well the retail sector, the hard-hit mall sector. And we did see that when Google or Apple mobility indices improve, property share prices tend to follow as well. And then the second would be the lift, or when the overhang surrounding offshore gaming operators clears, because this has been more than negatively priced in by the market.
Okay, thanks, Miguel. That's all we have for today. Have a good Valentine's Day and have a good week.
For the research mentioned, speak to your trading rep and check out market insights on the Maybank Trade app. Happy Valentine's Day and have a good trading week. I'm Noelle Lim on ASEAN Speaks, Maybank Investment Banking Group.